Hi, my name's Joshua Mahony, Chief Market Analyst at Scope Markets. This is the week ahead for the week starting Monday, the 1st of September, in a week that's going to be dominated by jobs and inflation, and in particular that US jobs report on Friday. So let's get into it. So as we see, the big ticket items for the week, according to Trading Economics, kick off on Monday with the Caixin manufacturing PMI number out of China. Remember, the Caixin number is based more around small to medium-sized enterprises rather than the larger firms that are covered in the headline number. Then we move into Tuesday. We've got inflation from the eurozone alongside the ISM manufacturing PMI number. That alongside the ISM services PMI number, which is on Thursday, do provide us key insights into both the employment side of things, but also the pricing side of things. So those ISM PMIs particularly important. Then on Wednesday, we've got GDP out of Australia, JOLTS job openings out of the US, and that kickstarts a phase that's going to be dominated by US jobs that ends with the jobs report on Friday. Thursday, balance of trade out of Australia and Canada, the US ISM services PMI, as I alluded to, and then wrapping up the week with retail sales out of the UK, the jobs report out of Canada, and the jobs report out of the US. So let's kick off with the US. It's been difficult to squeeze enough information onto this page, quite frankly. I've had to cut a few events out that I thought were probably worthwhile keeping in, but nonetheless, there's a lot going on, needless to say. Like I said, on Tuesday, we've got the ISM manufacturing numbers, and I've stripped out the new orders element of this, but you have new orders, employment, and prices, right? And that's what's good about the trading economic calendar. You can see that essentially it provides the breakdown for all of those sub-elements as well as the headline number. So headline number 48.2, an expectation of an improvement from the 48 seen last time around. Remember, the 50 threshold is the level that denotes when you're in expansion from contraction. So sub 50, which is where we are at the moment in US manufacturing, means that we're in contraction territory. But if you look at the subcategories, you can see that in actual fact, the number is heavily geared towards the fact that we're seeing such elevated prices, which is not necessarily what you want your strength to be in. So the prices element, the expectation is that this time around, we're going to see the prices element actually rise once again up to 66. So do we see those inflation pressures build? Well, the ISM PMI numbers could provide us leading indicators of exactly where those price levels are going. In terms of the employment element, there's an expectation that it weakens further. So again, this really reiterates the point that's been seen last time around, last month it will be, but I'm recording this within August. But the August jobs report, of course, we saw a weak payrolls number and then a big write down for the prior figure. And if we see at the bottom of the page here, 50k is expected this time around. So further weakness expected. And in actual fact, one of the leading indicators of that has been these ISM employment gauges, 43.2 expected, well below that 50 threshold. So clearly there have been signs of concern within the jobs market when you ask purchasing managers. Okay, Wednesday, JOLTS job openings. We can see here an expectation that we're going to see a sharp decline in terms of JOLTS openings, and then a decline in terms of quits. Now, quits is an interesting one because essentially JOLTS quits, I would say personally, denote how confident someone is that they can find another job. If you quit your job, by and large, most people will quit their job with a view to getting another one straight away, right? Rather than being sacked, being laid off, that kind of thing is more an indication that the company perhaps isn't in a good position. So if we see a decline in terms of quits, if we see a rise in terms of people being laid off, then that isn't necessarily a great sign for the US economy. So the fact that we're seeing a decline in terms of quits or an expectation, that again isn't actually a good sign. People leaving their jobs or feeling less emboldened to leave their jobs means that they don't see a good jobs market right now. Factory orders, minus 1.1 expected. That's better than last time around on the headline number. And then the core figure at 0.3%, a little bit lower than last time around. The Challenger job cuts, a rise in terms of that. The ADP figure, a decline in terms of that. So all of these figures are basically negative when it comes to the employment figures, right? So we're expecting a weaker manufacturing employment figure, a weaker job openings, a weaker job quits, a rise in terms of cuts, and then a decline in terms of the ADP payrolls figure. And then we have, of course, the jobs report where we're expecting 50k on the payrolls figure. So really that theme that's come around last time around about the massive revisions that we saw in the prior months, where we saw essentially, I think it was 258,000 jobs rewritten from the prior 2 months alongside the 73k that was announced, which was well below market expectations. That essentially really shocked the markets and suddenly made everyone think, look, the Fed are going to have to act in a decisive manner. And of course, we've since then seen that the appearance from Powell at the Jackson Hole Symposium, which emboldened people to think that we will be seeing some rate cuts over the coming months. And really, this all seems to feed into that narrative. There's an expectation of weakness pretty much across the board for this data. And that should point us in the direction of potentially additional rate cuts or greater expectation of a faster pace of rate cuts. So first and foremost, I wanted to show you a chart in terms of payrolls, but also the differential between that initial reading and the final reading. Because of course, last time around, the big story was all around the revisions, right? So I wanted to show you how revisions have looked in the past and to see whether this is any different. We have seen bigger revisions, and you can see, some of these bars are well above the last time around. But what we have been seeing over the course of the past, say, 5 or 6 months is that those revisions have been growing bigger and bigger, and they're pretty much all towards the downside. So the past 6 revisions have all come towards the downside. The past 6 months all had downside revisions. Of course, we don't have anything quite yet for the current payrolls figure, but that came in low anyway. So if we look at the top end, we can see that the sort of orange line more recently has been trading below that blue line. So we're seeing, once we see the final data coming out, then we see the revisions actually driving the figure lower. So the concern is that essentially when you see a weak figure like last time around, which is 73k, and then you bear in mind that 6 out of the last 6 have all been downwardly revised, that points towards a likely scenario that 73k is actually better than the reality. And the expectation of 50k means if we get 50k, then in actual fact, that might get revised lower. So all of that really puts a negative slant on things as we go forward. So there's the job side of things, but then, like I said, there's the ISM PMI numbers side of things, which I find really interesting. Now, like I highlighted, essentially you've got a situation where we've got the services and manufacturing PMI numbers being propped up by prices paid. So essentially inflation is the area of strength in here, not new orders, not employment. So it really, it pays to look into the nuts and bolts of these ISM figures. It really does. Drill down into it and see exactly what's strong, what's weak, because at the moment the part that you want to be strong is weak, and the part you want to be weaker is strong, and that's inflation essentially. That's prices paid, and certainly these purchasing managers are going to have a much better insight on exactly what the pricing pressures are under Trump. So you will likely see that feeding into the data. Of course, we've seen a major spike, but that has been sort of rolling off a little bit on the manufacturing side. It's remained elevated on the services side. So keep an eye out for that, because if we're talking about the data this week, you might say we don't have any inflation data, but in actual fact, I see these ISM readings as key inflation metrics to be watching out for. Now, in terms of the outlook for US rates at the moment, we've seen relative stability over the course of the past week. Of course, we had the Jackson Hole Symposium a week ago. And since then, we haven't really seen huge movements in terms of market expectations. Of course, there's a lot going on at the moment. There's question marks about inflation, PPI up at 0.9. There's question marks about the Federal Reserve with Donald Trump trying to push out Lisa Cook. There's question marks around the strength of the economy, and therefore we have the jobs report coming up in the week ahead. So there's a number of factors that will be playing into it. But right now, there is a feeling that we're going to get an additional 2 rate cuts, and at a push, we're going to see a move down to 350 to 375 by year end. Of course, I think part of the narrative is also going to be around where we are next year, because there could be some big change coming at the Federal Reserve. with Donald Trump essentially shaping things in his own image, and therefore we could see a much more dovish Federal Reserve the second half of next year, with Powell out in May. Perhaps earlier, depends whether Donald Trump gets his way. So all in all, we're looking at employment data that is weak, and therefore that could continue to feed into the narrative we saw last time around. Let's just jump into the chart for gold. So let me just grab this. Here we go. So this is the gold chart. And essentially, we're going to look first and foremost to look back at that jobs report that we saw at the turn. Here we go. So that was the jobs report last time around with those big payroll revisions, right? And of course, you can see here we've seen a sharp rise in terms of gold. That sharp rise comes in accordance to the idea that we're going to see a greater degree of easing from the Federal Reserve. Let's just add the US 2-year yield. Now, essentially, if we're going to see weaker yields, that means the idea is we're likely going to see additional easing from the Federal Reserve, and that boosts gold. So as you can see here, sharp decline there, and that provides the upside move for gold. So in which case, let's just invert it. We can see exactly how things look over the near term. So this actually needs to be expanded out. There we go. So here we go. So you can see that close correlation. At times you see it sort of move a little bit away from that, but certainly recently a close correlation in here. And so what does this mean? It means essentially if you see data coming out very weak in terms of the jobs report, weak in terms of some of these other metrics in terms of the jobs numbers, and those inflation metrics from the ISM don't suddenly grab the headlines with massive sort of gains in terms of the prices paid elements, then that's likely to further drive weakness in terms of the 2-year yield and likely going to drive further upside for gold. Of course, if we don't see that, if suddenly all of these sort of negative predictions in terms of US employment data are ill-founded and they all outperform, then we might not necessarily see that move. Now, what's notable here is that we've rallied up through trendline resistance. I've kind of tried to put this trendline at the extreme end of it, but we've also got that, which is probably the more relevant trendline with that initial single push through resistance there. In either case, we're kind of through that area at the moment, and crucially up through this resistance level that we have here, 3409. That points towards a potential bullish exit from this symmetrical triangle formation that's dominating the past, say, 4 or 5 months. And you can see that the idea then is that we see this as a continuation pattern within a trend. And the trend is very clearly defined. We've seen this pause. And in actual fact, if we were to overlay that 2-year once again, we can see that actually it's done very well during a period where we saw a sort of reversal in terms of rate expectations. Whilst we saw that sharp decline, and you can see it maybe a bit better on the daily, whilst we saw a sort of sharp decline here, we did see a pullback in gold, but by and large, I would say it was sort of consolidating to a greater degree. So there's confidence that we will see the bulls coming back into play soon enough. And that might be happening now with this rally up through trendline resistance and that horizontal resistance. Of course, if that is the case, and if we do see sort of weak jobs data this week, sort of hammering home the narrative that we saw last time around, that was the jobs report, remember, then it could point towards a breakout towards the upside. 34.35, that next resistance level beyond that 3,500 essentially, and a continuation of the bull market, right? So there's a good chance that this week could provide that bullish breakout here for gold, and that's why I wanted to particularly bring it to your attention. If we do see strong data coming out and it sort of pushes back against rate cut expectations, then I would say, then we're potentially going to move back into the triangle. Essentially would sort of reverse back towards the downside and maybe start heading back towards trendline support, but at the moment that's not necessarily market expectations, and I know there's a case of, well, market expectations are already priced in and therefore you need to beat it or come in lower than that. But I don't know, I think if we're getting weak weak jobs data across the board, it's certainly going to grab the headlines at least, bearing in mind many of these estimates have only just been released. So that's that. Let's move on to the next segment, and the next segment where we're going to talk about is the eurozone. Now, the eurozone is interesting to an extent this week in terms of the jobs data. In terms of the inflation data that's coming out on Tuesday. But it's also interesting because the weekend's on Friday, right? But then on the 8th, which by my reckoning would be the Monday, is the vote of no confidence in France. So you have a strong chance that the PM is essentially going to be out. So now you have the potential for significant instability in terms of European markets. That makes it a particularly interesting week because that's the backdrop that we're working towards. Like I said, on the inflation side of things, we've also got that. So the expectation on the inflation side is that we see a 0.2 month-on-month reading, headline up to 2.1, core up to 2.4. So a marginal tick higher across the board here. But by and large, we're around targets. I wouldn't necessarily say that this is sort of something that is really going to tie the hands of the ECB. Now, in terms of the sort of breakdown for both of those, you can see here the past few months in terms of the month-on-month readings for the eurozone figure. Inflation really has not been stoked in a meaningful manner. You can see that 3-month annualized dropping sharply at the bottom there. So recently, we haven't really had a problem with inflation. The problem really came in February, March and April. So that at some point is going to get stripped out. Now, if you look at where we've been in the past, so essentially we're stripping out the August figure from last year, which is 0.1. And that's why we could see a marginal tick higher because markets are expecting a 0.2 figure. But if we look back at the previous figures from last year, September, October, November, December, January, right? All of that sort of rotates around the 0 mark. So it means that one month we tick a little bit higher, next month we move a little bit lower. So I think that we're going to stay in the sort of low 2s for a while, and then we get that next bout of disinflation at the beginning of next year when we see the February, March and April figures stripped out. But certainly for the time being, I don't necessarily see a sharp rise in terms of inflation, but I do see a potential rise coming that could move us into the sort of 2.3s kind of area. Now, in terms of the core figure, that already is at 2.3, and you can see here that those big moves that we're talking about in February, March and April are really heightened on this occasion, but we also have the January -1 figure as well. So again, we're likely to see sort of minimal moves coming into play over the course of the coming months, and then it sort of ramps up with greater volatility in terms of the moves at the back end of this year. -0.6, then 0.4, then -1, then 0.6, then 1%, 1%. So massive figures really in terms of the eurozone core inflation metrics. But for the near term, relatively lowly figures, 0.3, 0.1, 0.2. So the next few months, I do think we're likely to see relative stability coming into play. Like I said, I think part of the theme really is going to be around what's happening from a French perspective as well. And that doesn't necessarily provide huge confidence per se. Now, the caveat here is that we have got a euro that's been very strong against the US dollar. And in part, that's part of a story that is, let's just jump onto that. Part of that is a story for US dollar weakness, right? Rather than just euro strength. But also, we have already seen the ECB cutting rates to a large degree. And so as we move forward, the pricing around future cuts eases for the Europeans, but it gains for the US. And that starts to turn things around into a more bullish narrative here for the euro that's already been gaining a significant amount of ground of late. So we can see here that essentially we're regaining ground over the course of recent months, but we're set within a bearish trend nonetheless. So do we see this trend as being something that essentially we're going to come back into play with? Are we going to see the bears return into the fold? So let's see. If we draw it from this is at least going to give us a quick guide on whether these peaks are lining up with it. So they're not really. So these near-term ones are, if we sort of grab that, and that would be the top level, that would be the sort of bottom, but that's picking up 3 of them in the middle there. So we're roughly around that area. From a fib perspective, if we were to see this as a potential area of resistance, so we're around that 76.4 fib. Nonetheless, like I said, we've also got the fact that we are moving into a phase where the Fed starts ramping up easing and the ECB do not. And so that provides the potential basis for further upside to come. Trendline resistance up ahead, you can see at the moment, set within this sort of ABC style retracement phase. If we do break up through resistance, which would come in the form of the 1178 level, then you're looking at a potential continuation here of this bullish trend for euro dollar. like I said, we're in a more bearish phase or in a more dovish phase when it comes to the US. We're seeing the jobs data rolling over. The inflation picture is the one major caveat. But as long as that remains under control, the easing from the Federal Reserve and the slowing down of the easing from the ECB can provide the basis for further upside to come for this market. If I was to say, let's get this and then do US to yields, put that on a different axis. Here we go. So if we're looking at price action recently, you can see that we are being relatively well influenced by that trajectory in terms of the relationship over expectations of monetary policy in the ECB versus the Federal Reserve. And that climb higher, you can see this pullback here, but then we've climbed up through that prior peak and moved onwards. That hasn't been replicated here in price action. So that's almost a bullish divergence that signals the breakout here in terms of yields that hasn't been replicated and signals the possibility of further upside to come in terms of euro dollar. And then finally, let's just jump into the final topic that we're talking about, and that is the Canadian region. So Canada, we can see here, has a jobs report as well. We don't have the forecasts up at the moment. I did put this together yesterday, so this might have been updated since. Let me just quickly jump onto it. So no, it has not. Okay, fine. So we don't necessarily have huge expectations for this. Of course, we've got question marks around the sort of breakdown when it comes to the relations over the border with the US and how much the Bank of Canada needs to step in as a result. They already have stepped in to a large degree, but unemployment is a problem, and you can see at the top end of this chart, that's the Canadian unemployment rate. It's been rising when some have been sort of flatlining, some have been declining. Canadian unemployment on the rise. So that points towards a potential need for the Bank of Canada to act, but we're not necessarily seeing it at the moment. 61% chance that we don't see a change in September. Then we see a potential rate cut in October. And beyond that, markets aren't really pricing much, quite frankly. That doesn't necessarily mean that that will be where the terminal rate is, which is 2.5%, or whether they do see additional grounds for easing. Probably comes down to exactly how the data comes out, right? So it informs us about the importance of that jobs report. Now, in terms of the chart to watch, I wanted to bring up the Australian dollar against the Canadian dollar. Now, not necessarily one that people trade all the time, but I think it's an interesting one. It's a very much a commodity focused pair. But I think what's interesting here is that we're sort of coming into this area of resistance within this range that has been dominating for a while. Now, you could say the bottom end of that range to some extent has also been sort of gaining ground. If you look at these sort of lows down here, you could say it's sort of a rising triangle formation. But the easier part of that to trade is the top end, right? Because it's flat. So at the moment, we're looking like we could potentially see another push higher, but worthwhile noting that we've got this resistance area here, which is 0.9 essentially, 0.9, 0.902. That zone looks like an area where in the past we have seen things start to roll over once again. You can see here on this chart 1, 2, 3 occasions that has happened. So if we were to see it gaining ground, we would need to see sort of relatively strong jobs data to point towards the Bank of Canada being a little bit more cautious for this to roll over. If we see a particularly weak jobs report, it could possibly see us rise once again. And notably, if we see a breakout through that 0.902 resistance level, it points towards an extension of the gains that have been playing out since those lows in April. As we can see here, from a wide perspective, we are set within a phase that is relatively bearish. Let's just go to the monthly actually. So we've got a long-term downtrend, but if we do break up through here, you still have the basis for us to potentially, let's just make sure we're sort of grabbing the right ones. So you've got this sort of area that you could still roll up into, right? So doesn't necessarily mean that we have to roll over once again just because we've got the swing high here. I think there is still a chance that we could come into this area. And if we see a particularly weak jobs report coming out of Canada, it could provide the basis for additional rate cut expectations from the Bank of Canada, weakening the Canadian dollar. But the flip side is, of course, we've got this sort of ascending triangle or range playing out at the moment, which provide the potential basis for it to roll over once again if we do see the jobs data coming better than expected. That's all for today. I hope that's been useful for you guys, and make sure to like, subscribe, follow, all that good stuff for more content like this. My name's Josh Mahony, Chief Market Analyst. Have a great weekend and have a great week ahead.